Most of you know me, but we may have some newcomers on the call. I am Bob Scott, president of Scott Strategic Investments. I've been in Pagosa Springs working with investors since 1998. Prior to that, I was an analyst on Wall Street and spent some time in private equity. I'm a certified financial planner, and we are a comprehensive wealth management firm. First of all, we hope that you and your family are mending from the disruption of COVID-19. Our thoughts continue to be with you during this period. This is the first of a series of online webinars we will be having over the next 6 months. Currently, our plan is to cover a number of topics that we are developing, but initially we are planning the following. February will be estate planning in the age of coronavirus. March, how tax planning changes through 4 stages of retirement. April, Social Security planning. May, tax review and recovery. June, a cybersecurity workshop. We will also have some market updates as the year progresses. We have a passion for educating investors and hope you find the information today useful. Let me also say that we are really working on making these webinars more interesting with engaging information and charts and dialogue. But we have a Toby in my compliance department, and they are very picky about what we can say regarding particular investments and the markets. If you don't know who Toby is, I encourage you to Google him and watch him on the television series, The Office. Personally, The Office was a highlight for me during my sequestration during COVID-19 and spending more time at home with my family. My son and my wife had a lot of good laughs watching it, and I highly recommend it. We hope to make, as I mentioned, things a little more interesting as we bring our own Toby up to speed in future webinars. On that note, we would love to hear from any of you if you have some topics you would like us to go over in the future. I'm going to try to keep this to about 50 minutes, and we'll stop at about 45 minutes for Q&A. With that, let's get started. Today's agenda is very straightforward. First, we will share with you a review of the equity markets. Then we'll discuss a 2021 outlook for investors and some planning ideas. Before we begin, it's always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive wealth management firm, we try to always consider the impact of any recommendations we make on not just one, but all these areas for our clients. Today's presentation will be primarily focused on investment planning and the equity markets. As a quick review, the U.S. stock market ended 2020 at all-time highs. After a waterfall drop and the quickest downward decline of the century, we had a snapback with historic support from the Federal Reserve and optimism about how quickly the economy is likely to bounce back. With that, the S&P 500 stock index, the most widely watched barometer of the equity markets, finished 2020 up more than 16%. A remarkable and historic plunge in subsequent recovery. In March of 2020, investors saw stocks plummeting 34%, starting a bear market. That bear market turned out to be the shortest downturn in U.S. history. Definitely not your typical bear market that is characterized by more of a cascading, protracted decline and preceded by a global recession. Since hitting bottom on March 23rd, the S&P 500 has risen 68%, shattering all-time records along the way. Clearly, investors who stayed the course were rewarded. While equities climbed higher from their March lows, not all stocks recovered to positive territory. In fact, as you start analyzing the year-end market highs, gains in Apple, Amazon, and Microsoft alone accounted for more than half of the S&P 500's 16% total return for the year. If you remove the top 24 performing companies dominated by tech and digital services, the S&P 500 return for the other 476 companies would actually be negative in 2020. The split market was also evident with dividend-paying stocks that also suffered for the year. Value, which has underperformed growth for about 14 years now, started to show some signs of life in the fourth quarter. Just a snapshot of the winners and the few losers that we saw in 2020. Interest rates, for compliance sake, I probably should emphasize that past performance is not indicative of future performance. Interest rates were not much help for investors in 2020, and they started 2021 at or near historic lows. Federal Reserve Chairperson Powell announced again at their December meeting that interest rates will stay close to zero for the foreseeable future. Congress also acted aggressively, approving $3.5 trillion in emergency relief and stimulus measures in 2020. This was the largest action in the face of a recession in U.S. history and provided some of the biggest aid packages in the world. Entering 2021, as the chart shares, interest rates are 0.09 for the average bank money market and 0.16% for the average 12-month certificate of deposit. But those rates, clearly less than 1%, can be very unattractive to income-seeking investors. Many of you have heard me say these rates are the lowest rates in 5,000 years, and I'm sure you thought I was exaggerating. Well, here's the proof. Going back to 3000 BC. Perhaps nothing has been more puzzling than the disconnect between the equity markets and the economy. The market's rebound reflects Wall Street's optimism about the prospects for 2021, but it also accentuates the disconnect between the stock market's wild success and struggling American households. Wall Street is at all-time highs, but many places are still experiencing shutdowns, high unemployment, overrun hospitals, and economic hardships. Sadly, many local businesses like restaurants, gyms, and some small shops may never recover or reopen. Everywhere you turn, you're reminded there is a deadly pandemic that is responsible to date for more than 400,000 American deaths and has also left millions jobless and hungry. In fact, as these statistics share, as of the year end, the COVID-19 daily cases, daily deaths, and hospitalizations were all peaking to their highest levels. There's a lot of optimism in the equity market about how quickly the economy is likely to bounce back in 2021 as corona vaccines become widely distributed. Investors are focused on the future, and the stock market is priced as a forward-looking indicator. Also, stocks remain appealing for many investors because interest rates are so low, making equities more attractive than other assets such as bonds. Don't forget the acronym TINA. There is no alternative. Our goal is to make sure that your investing plan is centered on your personal goals and timelines. For 2021, caution is still the principal notion for investors. Make sure you know what you own, why you own it, and have a plan. I am more concerned about the bubbly anecdotes than most anything else in the markets these days. When you start getting tips from the Uber driver or 20-somethings on TikTok regarding how easy it is to make money, that is very disconcerting. SPACs, another phrase used regularly now on Wall Street, is another cause for concern. I'm sure there'll be good ones, but there will also be bad ones. And we've always got to remember Wall Street is great at giving investors what they crave at exactly the wrong time. Let's turn now to our 2021 outlook. We begin 2021 with a new administration in Washington, D.C. Our job as financial professionals includes reporting and analyzing political activity and relaying how the new administration could impact the investment world. And for the most part, to be agnostic and focus on facts, not rhetoric and hyperbole. While all changes need to be monitored, some specific things that need to be watched include future stimulus, suggested tax increases, vaccine distribution success or failure, and trade agreements with key international trading partners, trading nations like China. Partners is clearly not what I meant to say. Many investors are wondering how a Democratic president with a Democratic House and an evenly split Senate, which allows the vice president to preside over ties, will affect the equity markets. While history is nice to look at, it is never a tell-all sign of the future. However, during 10 previous periods of similar circumstances that date back to 1949, 8 were positive for the 2-year period. For 2021, we will be carefully monitoring public policy and the new administration. In addition, one interesting fact, I believe during the first year of a president's time in office since World War II, there's only been 1 year that was negative for the market. And I believe that was Jimmy Carter, and the market was down around 7%. So what are analysts forecasting for 2021? Every year, Barron's does their roundtable, and the stock market enters 2021 with a generally favorable outlook. 10 market strategists were surveyed, and chief investment officers at large banks and money management firms on their outlook for 2021. Averaging their year-end S&P 500 forecasts, which range from 3,800 to 4,400, the group expects the index to rise 9% in 2021 to about 4040. At a dividend yield of around 2%, and their forecast shows that U.S. stocks could return a total of 10 to 11%. This panel also predicts the U.S. economy will grow by 5% in 2021, its fastest rate since 1984. That would be healthy following a year in which gross domestic product plummeted by 31.4% in the second quarter as the pandemic gripped the country, and soared by 33.1% in the third quarter. While this forecast is optimistic, we like to remind you that we consider your feelings about risk and the markets when we review your unique financial situation and make recommendations. There's great optimism about how quickly this economy is likely to bounce back this year, as COVID-19 vaccines become more widely distributed. However, for 2021, there are still many uncertainties and risks, vaccine rollout being a principal one. We could see a delay in economic recovery for any number of reasons. Again, one of the things troubling to me is the proliferation of cheap, easy day trading and speculating by younger retail investors with no regard to investment fundamentals. I don't believe it presents a huge systemic risk, but it is indicative of some pockets of bubbles out there. Again, the biggest potential for risk is the vaccination campaign in the U.S. So let's hope that gets going. 2021 should be an interesting year, and our goal is to be communicative with clients on how things are proceeding. Key risks, according to Goldman Sachs. The 5 largest stocks, Facebook, Amazon, Apple, Microsoft, Google, have been the big winners in 2020. Some of those returned upwards of 70% in 2020, and they comprise up to 25% of the S&P 500 market cap. They've had 10 years of fast sales growth and trade at high PE multiples of roughly 29 versus 18 for the rest of the market, but they're great companies. So we don't want to count them out, but the liquidity from the Federal Reserve, low interest rates, likely to add to some bullishness and sky high valuations out there. Again, before we get to some planning ideas, quick recap. 2020 was a year that rewarded discipline. Interest rates are at or near all-time lows, the lowest in 5,000 years. Clearly, there still remains a large disconnect between the economy and the equity markets. New administrations, not just this one, any new administration brings new challenges, and the effect of the COVID-19 rollout is still critical to investor success. Whether through Biden or Tax Cuts and Job Act expiration, change is in the air. Huge debts and the largest deficit outside of World War II will likely cause some type of tax increases. We can't control a lot of things, but we can plan and prepare. 6 planning ideas for 2021 and beyond. All of these items could be significant or marginal depending upon your individual situation. The goal is to maximize after-tax income and returns. And with interest rates being near the zero bound, that drives all investments expected returns down. And so we need to be mindful of taxes and tax planning to maximize our after-tax return. So 6 ideas. Now that the election's well behind us, it's a good idea to take the opportunity to prune your portfolio and make any additional changes. In this case, I want to talk about location, and asset allocation. Asset location is different than asset allocation, and both matter. Asset location is about choosing which asset goes in which type of account. Basically, we have pre-tax accounts like traditional IRAs and 401ks, accounts that are funded with after-tax dollars then grow tax-free, Roth IRAs or Roth 401ks, and taxable accounts. Some basic rules of thumb: income-oriented investments should generally be held in a tax-deferred account, and investments with big appreciation potential, you may want to be putting those in a Roth so they grow tax-free. But as with a lot of things, it always depends. The moral of the story is not what you make, but what you keep. We're big fans of Roth IRAs. We believe tax rates are structurally going to go up. And asset location is a good prioritization tool to figure out which assets should go where. Again, the idea being to maximize after-tax income and maximize growth. Asset allocation, on the other hand, generally refers to the allocation of stocks versus bonds, an important factor, if not the most important. According to Goldman Sachs, a 60-40 portfolio is estimated to return 4.2% annually for the next 10 years. Those that simply purchase the index funds may be disappointed in the next 10 years. Goldman predicts market returns will be based on earnings growth and not necessarily multiple expansion. Despite rosy short-term predictions, they only predict 6% equity returns annually for the next 10 years, although they do predict a 90% chance that equities will beat bonds over that time period. Again, 60-40, we've been hearing it's dead for a number of years now with interest rates being so low. But again, to underscore it, bond returns will likely be disappointing given their low starting yields. Some solutions would be to consider high yield, emerging markets, move down the capital ladder to smaller and medium-sized companies. This is an important theme given earlier I talked about how much the FANG stocks have run, but you still want to stay growth tilted, but you also want to have some value in cyclical stocks in your portfolio. Again, I just can't say it enough. Poor outlook for bonds. Goldman predicts a 1.6% estimated annual return on 10-year U.S. Treasuries for the next 10 years. Bonds are just set up to be a huge disappointment going forward. And the bull market in bonds is likely over, as yields are unlikely to decrease from here. Personally, in my opinion, I think this is one of the most interesting unknowns we as investors face. We are in uncharted territory, and as Jeff Gundlach recently said, he's also known as the bond king. He believes it's a coin toss whether we see deflation or inflation. So, in our opinion, more important than ever to be really diversified. Again, as we talk about portfolio construction, asset allocation, make sure you've got, Goldman calls it these three legs to the stool. Growth, which we've talked about, the FANGs, technology, healthcare, recovery trade. These would be more cyclical industries that are going to recover as the economy recovers and the pandemic recedes. Then this last one, a big word, idiosyncratic targeted alpha strategies. Basically, what they're talking about here is think about adding an element to your portfolio that is doesn't act like a typical stock or bond. This could play, this could be emerging markets or high conviction trades. Any number of non-indexy investments. Again, growth, we think you still want to maintain growth. If the economy does slow down, growth typically outperforms value. So again, don't give up on any of these asset classes in your asset allocation. Recovery stocks, not only those companies that are going to benefit from a reopened economy, but small and medium-sized companies should have feel the tailwind from a recovering economy more than those larger companies. International, we think is really going to start to get some steam this year. It's important to remember that 78% of the top performing companies in the MSCI index are not U.S. located, and that grew to 90%, and it grew to 90% in 2020. And for those of you who object to international, don't forget you're buying the company, not the country. The third leg of the stool can be a combination of strategies designed to be non-correlated. Again, these could be emerging markets, international with active managers, credit opportunities, environmental or renewable stocks, hedged equity, long or short. I think one area that is going to see some good traction and tailwinds in 2021 is emerging markets. Again, that could be for a number of reasons. They're inexpensive relative to the U.S., number one. Number two, a declining dollar is likely. Number three, I tried to put this idea in pictures, but number three is, there's a lot of international stocks that just have not been overfished like the U.S. Large cap growth stocks. The FANG stocks, everybody in the United States is investing in the FANGs. Emerging markets look more like this guy and his dog on the right. So don't forget international and don't forget emerging just because it's been unattractive the last few years. Believe it or not, that's planning idea number one, location and allocation. Number two, understand the need for tax planning. Tax planning is a year-round activity, and I believe this is really going to get interesting over the next couple of years. And again, I did not want to be hyperbolic or incendiary in talking about some of the proposed tax changes with the new administration, but I think they could be significant. Tax bracket management. The Tax Cuts and Jobs Act provides exceptionally wide tax brackets that investors should be leveraging, whether for tax bracket management, filling a particular tax bracket, not going above, or Roth conversions. Many underestimate the benefit of capital gains planning. 0% capital gains rate is beneficial and underused. Consider using ordinary income to offset itemized deductions and fill up the bucket with capital gains. Again, depending upon your income and gains, it's quite possible that you could be in a 0% capital gains bracket. Take advantage of that. Be aware. Again, we think people should be looking at this throughout the year, not just at the end of the year. Number three, retirement planning. It's not how much you make, it's how much you keep after taxes. Think of retirement income planning or retirement income optimization. Forgo the conventional wisdom. Withdraw from IRAs when in low income years or low tax brackets. In the old days, we always used to say, you're not going to touch your IRA till, you absolutely have to. Well, if you're trying to manage your tax brackets and trying to stay, in a lower bracket rather than a higher bracket, you may want to start looking at taking some money out of your IRAs prior to when you have to take required minimum distributions, which is now 72. It used to be 70 and a half. It's now 72. What that does is it reduces your IRA balance. And remember, traditional IRAs are taxed, every dollar that comes out of a traditional IRA is taxed at ordinary income tax rates. So you want to be chipping away at that IRA over the years going forward now that taxes are likely to be higher in the future than they are today. Qualified charitable distributions, another tool to chip away at a traditional IRA. It's an efficient means of reducing income and helps to limit, stealth taxes such as Medicare and Social Security, et cetera. Basically, a QCD is you make a charitable distribution direct to a 501c3 and don't pay taxes on that distribution. It goes direct to the charity. You have to be 70 and a half, and you can do up to 100,000 per year. Roth conversions, tax-free withdrawals are a friend. Big believer in the idea of Roth conversions. Tax-free growth and tax-free withdrawals in retirement, great idea, especially given the likelihood of higher taxes. The Secure Act makes large traditional IRA balances dangerous. And that's kind of what we're getting at here with these ideas is you don't want a ticking time bomb in terms of a huge traditional IRA. And one of the main reasons is used to be that you could stretch that IRA, after your primary beneficiary received it. Once they passed, they would typically, your kids would inherit it. and they would stretch it out over their lifetime. Well, now non-spousal beneficiaries have to deplete 100% of the inherited IRA by year 10. So if it's a large IRA balance, it could blow up the heirs' tax bracket. So again, Roth doesn't have that impact. It's tax-free. If you're still working, take advantage of the deferral opportunities, whether through maxing out IRAs or qualified retirement plans. Don't forget spousal IRAs for the added deferral opportunity, as only one spouse requires income to take the spousal contribution. So for example, if one person is working and the spouse is not, even though the spouse does not have earned income, the working spouse does, so the spouse can make an IRA contribution. Always consider Roth 401ks, as over 50% of employers now offer them. You're going to hear more and more and more about this in 2021 and 2022. Idea number 4, estate planning, definitely going to be making a comeback. Thanks to politics, shifting laws, the Secure Act, and sunset of TCJA, estate planning is front burner again. There are lots of reasons to be engaged in estate planning, tax and otherwise, although many people neglect this important area. Again, we're going to be having we're going to have a webinar in February with some estate planning ideas. They may do away with GRATs, flips, IDGTs in the future, so do not procrastinate. If you have a large estate that could be taxed, if you have a large estate, it could easily be taxed in the future if they decrease the lifetime exclusion. Lots of talk about that. Nobody knows where that's going to end up. Use it or lose it, as they say. Consider making gifts now, as the IRS has already confirmed that there would be no clawback when the lifetime exclusion is decreased. I'm hearing some waffling on that right now, so something to consider there. I can't give tax or legal advice. Also, don't forget the basics. Has your estate plan been updated? Do you have the critical documents that you need? Will, power of attorney, healthcare power of attorney, any necessary trusts? Do you have the proper executors and trustees listed? And make sure your beneficiaries are all updated. Some things to consider. If you've got a high probability of achieving your financial goals in retirement, et cetera, seriously look at doing some gifting now. Deathbed planning. You can't die with losses. You want to use those or transfer to the younger spouse. So again, just some things to be aware of as we kind of begin to face the specter of tax changes and likely increases. Number 5, general planning, the old tried and true blocking and tackling. Don't forget it. Planning is trying to see around corners, and tax preparers are not always doing this type of work these days. A good financial planner can be a big help here. Everyone needs a plan, especially if you're close to retirement or in retirement. Always consider updating your plan if you've got changes. Review your company benefits. Identify all the perks. Major life planning, job changes, moving, retirement, marriage, etc. These all need to be taken into account when you're designing a financial plan. Education funding, 529 plan, Coverdale accounts. There's some talk of student loan forgiveness, but nothing well defined at this point that I've seen. Are you on track to meet your financial goals? Everyone needs a plan. Number 6, don't forget distribution planning and Roth IRAs. Roth IRAs, again, kind of beating the drum here. Roth IRAs remain one of the best ways to create multi-generational income tax-free wealth. And with taxes on the rise, there's never been a better time to consider a Roth. Lock in lower rates now to prevent higher tax rates later. Again, Roth conversions make sense in a whole host of situations. We think everybody should be looking for that, Roth conversion gap year or down income year. So again, always be thinking, is this a good time? Is this a good year to convert to a Roth, etc. 7 reasons to love Roth IRAs and Roth conversions. Again, pretty self-explanatory. We've hit a lot of these. A lot of practitioners complicate this. Don't. Roth IRAs allow you to lock in current low tax rates and to create lower taxes in the future. If you're married and filing jointly, convert as much as you can to stay in the 24% tax bracket. Again, we think people ought to take a hard look at this, and I think it's going to be self-evident as we get more information on tax changes. Tax bracket management, very wide tax bracket thanks to TCJA. Whether with new tax laws or not, these will be going away in 2025. Tax rates are historically low and will likely be gone in the future. So, these are going to drift upwards, right? 37 is likely to become 39.6. I think this is where the majority of the changes are going to take place, these, 35, 37 areas. But when we talk about tax bracket management, here's a good visual. If you're right in the middle of the 12% tax bracket, that's an easy conversion, right? Until you hit the step up to the 22% tax bracket. So again, pay attention to where you're at and take advantage of the brackets that you find yourself in. So 6 planning ideas for 2021 and beyond. That was a lot. I'll summarize it here. Review your portfolio's asset location and allocation. Locate, income generating investments in something that's tax deferred, generally speaking, and growth assets in something that's tax free, like a Roth, generally speaking. Again, everybody's individual situation, may change things, but those are general rules of thumb on asset location. Allocation, big driver of returns. Make sure you are really well diversified and have assets allocated domestically, internationally, small caps, mid caps, and growth and value. And of course, our big word, idiosyncratic alpha strategies. Understand the need for tax planning. We've had a pretty easy road here recently, I believe. This is going to get much more complex and much more challenging, especially for those that find themselves in the upper tax brackets and also with significant estates. Retirement planning for peace of mind. Be thoughtful, know what you own and why you own it, and maximize tax distributions. Estate planning is coming back. A couple thoughts there. Estate planning is coming back. What we mean by that is estate taxes are likely going to change. There's also talk of potential change in the step up in cost basis, et cetera. So people are going to want to get more thoughtful and creative with estate planning. Again, blocking and tackling, never a bad time to look at your plan and your portfolio and make sure you're doing everything you can to maximize your after-tax returns and accomplish your goals. And don't forget distribution planning and Roth IRAs. A lot easier to think through retirement income if you've got a lot of money in a Roth IRA. You know, one thing I just want to touch on, we hear a lot of headlines about a market crash or a decline, this or that, people trying to predict the future. You know, a 10% decline is totally normal. And the historical frequency is about one time per year. 15%, you know, once every 2 years. So, you know, expect a decline this year. I mean, it would be in the cards for us to see a correction. I hope I'm wrong, but again, it's likely baked into the cake. Same story, different way to look at it. The red numbers are the you know, the intra-year drops. So here we can see 2020, right? Market dropped down at one point in March, 34%. Lo and behold, at year end, it closed up 16%. So again, we can see that market declines are normal. Have a plan, don't panic. So some takeaways that I put together here. You know, I didn't touch much on politics. I'm kind of tired of hearing it, but don't get tied up in politics and investing. Two different ideas here. You know, I had plenty of clients that wanted to sell everything when Barack Obama was elected, when Donald Trump was elected, and when Joe Biden was elected, and that would have been a bad decision. So keep those two ideas separate. 60-40 is probably dead. It's probably finally dead because interest rates are so low. So again, makes absolute sense to try to maximize your return by controlling some things that you can control, like where your investments are located and how they're allocated. You always hear this from me: caution and vigilance are critical. That's the way we look at things. The next 10 years likely won't look like the last 10 years. Again, no guarantees. Past performance is not indicative of future performance, but there are a lot of interesting factors and cross currents going on these days. One of them, ESG investing. We'll have a seminar on that, a webinar on that in March. You may want to tune into that. Again, that's a area that's driving a lot of institutional investing decisions and individual investing decisions these days. If you're retired or close to it, planning and all of these issues are even more important. Underline, bold, you know, hugely important. Focus on your own personal goals and objectives, not what the Robinhood traders are doing or anybody else on TV. Focus on your goals and objectives. That's all that matters. Call us with any concerns. Legendary portfolio manager Peter Lynch reminds us that you get recessions, you have stock market declines. If you don't understand that's going to happen, then you are not ready and won't do well in the markets. Again, what else can I say? So what can you expect from us? One of our main focuses is to review changes for our clients on an ongoing basis. You can expect regular communication, more frequent discussions, and you can expect that we are continuously reviewing economic, tax, estate, and investment issues for our clients. In fact, we will be offering other workshops that focus on tax changes and some planning ideas. Also, you know, I would just say I've told many of many of our clients that if any of your family or friends ever have any kind of a money question or concern at all, I don't care what it is, have them give me a call and I'll get them the answer to that question. And for many of you that have referred family and friends, thank you. We really appreciate your trust and confidence in us. And for those of you that may be on this webinar that are not clients, let me say that we offer a complimentary, no obligation initial consultation. We'd be happy to talk to you. So let us know how we can help. Thanks for attending this webinar, and we will look forward to talking to you in the months to come. Again, our goal is to keep you informed, and thanks for watching our update, and let us know if there's something we can help you with, or something in particular you'd like us to talk about on one of these webinars.